All right, time for today's three-stock lunch. We are going to make it Fed-focused today. Why not? We asked our trader for three stock picks for three different Fed scenarios that we might hear on Wednesday. Here with our trades, Chris Grisanti, Chief Equity Strategist at MAI Capital Management. First up, Chris, your pick for Fed scenario number one, which would be a quarter-point cut with a bias in the statement or the press conference to less aggressive cutting down the line. In other words, more caution in the narrative, but action on the table. You picked Alphabet. Why?
Sure. I did because, Tyler, that's my steady as she goes scenario. I think that's a signal from the Fed that everything is kind of steady and that the economy is in okay shape. They're not terribly worried. So that, to me, speaks of an environment where the economy doesn't slump. I think Mag 7 will ride again. And it's Google's down about 20% from its highs. It's about as cheap as it gets. And with a stable economy, it should bounce back nicely. Advertising revenue will still be strong. Also, while nobody ever talks about it these days, I like the Waymo piece a lot. That's the autonomous driving. And you're not really paying for it. So a steady as she goes scenario says Google to me.
You're right. More and more people, Chris, are realizing what that company is up to and its potential. A partnership with Uber last week. So you get Waymo as a kicker. Okay, so let's move along to Fed scenario number two, which you call medium panic, which would be a 25 basis point cut and a bias for more aggressive cutting. And for that, this surprised me. Your pick is Domino's Pizza. Explain.
Right, sure. So I call this the we're a bit concerned scenario. I'd buy Domino's Pizza because, again, not unlike Google, it's down to a 10-year low on valuation, in this case on international sales issues. So I think it's got a floor here. And pizza is a recession-proof food. Management has a plan to turn things around. And in this middle scenario, people will still go out to eat and they'll order in, but they're going to watch what they're spending. So here's a kind of a low value restaurant chain that's down on its luck, but has staying power and a strong brand. So I like Domino's, and that's
all righty. And finally, we've got the third scenario, what might be described as a full-on panic. I don't know whether I'd go that far, but it's a half-point cut, and your pick here is Hershey.
Yes, and I think Kelly will smile about this one.
I am.
I call this scenario the yikes, we're behind the curve, but don't tell anybody scenario. So this is the Fed trying to catch up. The economy is slowing too much in their minds. They, of course, are seeing much more data even than we are. So that 50 basis points cut is going to make me kind of nervous. So I'm going to be reaching for staples. I particularly like Hershey, as I've mentioned on this show before, because they're going to benefit. They've been crushed by higher cocoa prices. That's starting to alleviate. They've got strong management keeping earnings solid, even with those tough cocoa prices. When that starts to go the right way and the economy starts to slow, that's the time that Hershey's can really shine. It's a sweet pick.
Yeah.